We're looking at 15.3 here today, adjusting accumulated depreciation. And basically what we're trying to do when we do all these adjustments is to get the accurate value of our assets. So in this case, we have a couple different types that we're looking at. So like when we adjust for supplies and we adjust for insurance and merchandise inventory, we're trying to get the next fiscal period set up. So we have these current assets, items that can be exchanged within a year, and then we have these plan assets that are useful for a number of years. But these plan assets, we have three different types: equipment, building, land. And what we want to do with these plan assets is to accurately say how much they're worth when we start the next fiscal period. All right. They give you an example display case, or whatever amount. Let's say you buy something for $10,000 in year zero. 5 years from now, it's not worth $10,000. Usually, it's worth less. Now, there's exceptions, land, buildings, things like that sometimes are worth more, but for the useful life of equipment, it usually is depreciated. And so we will have to match expenses with revenue, and we want to expense that out over each year. So how we do that is we take the original cost of the asset and we subtract the salvage value, the scrap value. If you heard of salvage yards, we subtract how much it would be worth if we sold it at the end of its so-called useful life, which is the number of years we think it'll be worth something that is functioning and it works well for us. So we're going to use the straight line method. There's a lot of different methods of depreciation, but we're using the straight line method. And so this is an example they give us, and this is all in your notes, where you take the original cost minus what you can sell it for after it's all said and done. So salvage value, if you took a car to the salvage yard, salvage value is 500. So we subtract that from the original cost to get our estimated depreciation expense. We divide that over the useful life. They give that to you. It's like an industry standards type thing. You usually, like our football field, you can do 10 years. We got 12 out of it last time. So it's a guide. It's not necessarily set in stone, but it's a guide. So that our annual depreciation is the depreciation expense we found divided by its useful life is the annual depreciation. So if we bought this item in year zero and we have $400 depreciation every year, we're at $800 after year two, right? $400 for year one, $400 for year two, so it's $800 here. We get our next year's depreciation expense, and now after year three, our depreciation expense is $1,200, $400 a year. That is the accumulated. It'd be like snow. It rains 1 inch one day, 1 inch the next day, 1 inch the next day, 1 plus 1 plus 1. It gives us accumulated depreciation or accumulated snow. So then we'll take the book value minus this accumulated depreciation, and we'll get what our ending book value is for that item at the end of year three. So when we get to our problem, excuse me, it says we're buying a color printer for $950. That's the original cost. The printer has an estimated salvage value of $150. So we subtract that amount to get our estimated total depreciation, divide it by its useful life of 5 years, and we get our annual depreciation. When you go to calculating the book value, okay, we already have that. So now we do original cost minus the year one depreciation. It says book value of the second year, so we have to subtract the second year. And so we're subtracting $320 from $950 to get this $630. And then when we do that, we have to record this into our journal. And so they're giving us a different scenario here where it says Southside Electric determines total depreciation for office equipment, for all the office equipment, of $2,150. So it's not just the color printer, it's all of them. So $2,150 is depreciated expense for that year, and then our total accumulated depreciation is the credit. They again give you the store equipment. Our total accumulated depreciation for store equipment is $7,444, which we debit into the expense because we're expensing it. We're matching our revenue, all the money we made, and then all the expenses that have helped us. These equipment, office and store helped us make that money. We need to depreciate it, so next year or next fiscal period, we're not showing that the asset is a value of something it doesn't, because these assets depreciate over time. So you'll be able to do this work together, very similar as the application problem, and use these, go over this notes, because there's a lot of good information showing you how to do this, and you should be good to go.